So, usually when you step up to one of those really high-end luxury espresso machines, the ones, those gleaming Swiss-engineered masterpieces that cost about as much as a used car.
Oh, yeah, absolutely. They look like spaceships.
Right. And there's this expectation of just, well, absolute seamless magic. You press a single sleek button, the machine sort of hums with this quiet authority, and exactly 30 seconds later, you get a perfect cappuccino.
And you just assume it's magic or, Swiss engineering at its finest.
Exactly. We like to imagine this master Swiss craftsman in a snowy chalet somewhere, just hand-tuning the water pressure. But if you actually step into the reality of global supply chains, that romantic image totally shatters.
It really does. Because
Yeah.
we're actually looking at a manufacturing landscape that's completely hidden in plain sight,
Yeah, and it turns out the true genius, the actual brain making that Swiss machine hum, isn't in Switzerland at all. It's actually sitting in Penang, Malaysia.
which is, the detail most people completely miss.
Right. And they're operating under this business model that most people completely misunderstand. But the crazy part is, right now, the company that builds those brains is going through a massive stock collapse.
Which honestly presents a super fascinating puzzle for the market. I mean,
Right.
we have a company that serves as the central nervous system for these top-tier global luxury brands, and suddenly they're watching their valuation just fall off a cliff.
Yeah, and so the core question we have to answer for you today is whether a 25% drop in share price is a structural warning sign or maybe the most mispriced fire sale opportunity of the year.
It's the classic deep value setup, or value trap, depending on how you look at it.
Exactly. So, okay, let's unpack this. We're doing a deep dive into Uchi Technologies Berhad, or Uchitec.
Yep, Uchitec.
And the goal today is to really strip away the heavy finance jargon. We want to look at the actual mechanics of this business as a detective story.
Because it really is one. We've got this secretive origin story to get through first.
Right. And then we're going to break down the what we're calling the triple threat, these three distinct macroeconomic factors that absolutely crushed their stock recently.
And after that, we'll analyze their newest product line, the things that are supposed to, save the revenue sheet.
Yeah, and finally, we'll crack open their valuation. We need to see what their massive cash fortress is actually worth to you, the everyday investor.
Because that cash pile is no joke.
So, to understand why Uchi's stock just plummeted from RM 3.45 all the way down to RM 2.59 recently, we have to start by totally changing how we view manufacturing.
We really do. Because when most people hear electronics manufacturer in Malaysia, they immediately picture, I don't know, a giant assembly line.
Yeah, just thousands of people stamping out cheap plastic widgets.
Exactly. And that assumption is basically the single biggest mistake you can make when looking at Uchi.
So explain that. What's the fundamental difference here?
Well, to really evaluate this company, you have to understand the massive chasm between an OEM and an ODM.
Okay, OEM versus ODM. Break that down for us.
Right, so most of those massive electronics factories you see globally, they're OEMs, original equipment manufacturers.
Like Foxconn making iPhones, right?
Yeah, perfectly good example. I actually like to think of an OEM as a highly skilled construction crew.
Okay, I follow.
So if you're an architect, right, you draw up these incredibly detailed blueprints for a house, and you hand those plans over to the builder. The builder executes the plan perfectly.
They lay the bricks, put in the windows.
Exactly. They run the wiring. But here's the catch. They don't invent anything.
They're just following instructions.
Right. So if you, the architect, suddenly demand a much lower price and the builder refuses, well, you just take your blueprint to the construction crew across town.
Oh, I see. So the OEM has practically zero leverage in that relationship.
None. They are completely replaceable because the intellectual property, the actual genius of the design, lives with the customer, not the factory.
Which means margins are terrible because everyone's just competing on who can build it cheapest.
Precisely. It's a race to the bottom. But Uchi is not an OEM. They are an ODM, an original design manufacturer.
Okay, so what does that actually look like in practice?
It means they don't just take orders from a finished blueprint. They are the architect, the electrical engineer, and the software developer all rolled into one.
Wait, so the brand doesn't even give them a finished design?
Nope. A brand comes to Uchi with just a concept. They might walk in and say, hey, we need a coffee machine interface.
Like just a vague idea?
Well, specific goals. They'll say it needs to instantly switch a boiler from brewing temp to steam temp, and it has to perfectly froth oat milk to exact microfoam specs.
That sounds complicated.
And they'll add, oh, and display it all on a high-definition touchscreen without any lag whatsoever.
So Jura just gives them the wish list, basically.
Exactly. And Uchi has to figure out the actual physics and the software architecture to make that theoretical concept real.
Oh, wow. So they're inventing the hardware logic from scratch.
Yes. They design the custom-printed circuit boards. And honestly, most crucially, they write the proprietary code.
So they actually own the intellectual property for all the internal brains of the machine.
They do. They own the control modules.
Yeah.
They're literally programming the central nervous system of the device.
That's fascinating. But I'm kind of struggling to see how a company based in Penang ended up becoming basically the Intel inside for a luxury Swiss coffee brand.
It is a pretty wild trajectory.
Yeah. I mean, how does an ODM relationship like that even start? Because from what I've read in the research, the timeline here doesn't even start with coffee.
It doesn't.
And it doesn't even start in Malaysia.
Right. So the origin story actually traces all the way back to 1981, and it started in Taiwan.
1981 in Taiwan, okay.
Yeah, it was started by the Cao brothers, specifically Ted Cao, who founded Uchi Electronic. And you're totally right. They were nowhere near the coffee market back then.
So what were they building?
Their initial breakthrough was actually designing electronic modules for bathroom scales.
Wait, really? Bathroom scales?
Yeah, for the German brand Krups.
Okay, going from a bathroom scale to a highly pressurized thermodynamic coffee machine seems like a pretty massive leap.
I mean, on the surface, yeah, it sounds crazy. But if you think about it mechanically, they actually rely on the exact same foundational engineering.
How so?
Well, think about how a digital bathroom scale works. It takes a physical analog input, in this case, human weight, pressing down on a load cell.
Right.
And it has to convert that analog pressure into a highly precise digital readout using a microprocessor.
Oh, I see. It's all about converting physical force into digital data.
Exactly. Ted Cao spent years perfecting that exact specific conversion of physical pressure and measurement into digital information.
That actually makes a lot of sense.
And when you look at a high-end espresso machine, what is it really? It's a machine that has to precisely measure the analog pressure of a water pump.
Right, and the heat.
Yep, it has to monitor the exact temperature of a thermoblock heating element and control the flow rate of the liquid.
So the underlying discipline, the sensor integration, the digital control systems, it's basically identical.
It's exactly the same skill set, just applied to water and heat instead of weight.
Okay, so the tech transition makes total sense. But what about the geographic move? You said they started in Taiwan, but today Uchi is basically synonymous with Penang.
Right, so that shift happened in 1989, and it was really driven by something called the Look South policy.
What was that?
At the time, Taiwan was actively encouraging its domestic companies to expand their manufacturing footprint down into Southeast Asia.
Trying to find cheaper labor.
Cheaper labor, more favorable cost structures,
Yeah.
and just a way to expand their industrial capacity overall. So Ted Cao moved the operations to Penang, Malaysia.
And Penang is a pretty big tech hub now, right?
Oh, absolutely. Even back then, it was rapidly establishing itself as the Silicon Valley of the East.
Right, they had the infrastructure.
Yeah, they had the engineering talent, the logistics, and these great free industrial zones that were perfect for an export-driven tech company.
So they set up shop there and just kept growing.
Yep, eventually listing on the main board of Bursa Malaysia in 2002. And that family legacy is still very much intact today.
Really? The Cao family is still involved.
Yeah, Ted Cao's nephew, Stanley Huang, actually serves as an executive director right now.
Oh, that's cool. So looking at their current revenue split, though, it seems like they took that foundational sensor tech and split it into two vastly different industries.
They did.
Because the research shows roughly 80 to 90% of their revenue comes from what they call the art of living segment, which is a very fancy name.
It is a very corporate euphemism, yeah.
I have to assume that's just a fancy way of saying the Jura coffee machines.
It basically is.
Yeah.
That is the core engine of their business. Art of Living covers high-end household luxury goods, and Jura is just the undisputed crown jewel there.
Okay, so that's the big chunk. But what about the rest? Because the remaining 10 to 15% is where things get kind of wild.
Yeah, that's their biotech segment. And honestly, this is where their engineering pedigree really shines.
The biotech segment is barely even mentioned in most of the retail analysis I've seen. People just talk about the coffee. What are they actually doing in a lab setting?
Well, they're taking that exact same expertise in precision control and applying it to, like, mission-critical laboratory equipment.
Mission critical? Like what?
We're talking about designing the mixed signal control systems for high-speed centrifuges.
Oh, wow.
Yeah, and the temperature regulation modules for ultra-low temperature deep freezers, the kind they use for storing super-sensitive biological samples.
That's a huge step up from coffee.
They also build these incredibly high-precision light measurement instruments.
See, the stakes there just seem exponentially higher. I mean, if a coffee machine fails, someone gets a lukewarm latte, which is annoying, but fine.
Right, but if a mixed signal control system on a medical centrifuge fails,
Exactly. A blood sample could be totally destroyed. Or a diagnostic test could give a false positive.
which is exactly why that biotech segment is so critical for understanding Uchi's true value, even if it's a much smaller piece of the revenue pie.
It's like a proof of concept for their quality.
Exactly. Designing electronics for medical and lab equipment means you have to adhere to these brutal, unforgiving regulatory standards.
The components have to have what? Near zero failure rates?
Near zero, they have to operate perfectly under extreme stress and totally variable conditions.
So the fact that Uchi can actually secure contracts in that biotech space is basically the ultimate validation of their engineering.
It proves their code and their circuitry aren't just, good enough for a luxury kitchen. They are robust enough for rigorous scientific research.
Okay, but I want to push back on this business model for a second.
Yeah.
Because as an investor, looking at a company where 80 to 90% of the revenue is tied to one segment.
And primarily one massive customer.
Right. Primarily Jura. That just feels like a catastrophic vulnerability.
It's definitely the elephant in the room.
I mean, traditional investing wisdom basically screams that heavy customer concentration is a massive red flag.
It usually is.
So what happens if Jura's procurement department just wakes up tomorrow, looks at a spreadsheet, and decides they want to squeeze Uchi's margins?
That's the big fear, right?
What stops Jura from just, I don't know, hiring a different ODM in Vietnam or Eastern Europe to build their control modules for 20% less?
Okay, so this is actually the most common critique of Uchi. But to understand why it hasn't happened, we have to look closer at how software moats actually function in hardware manufacturing.
A software moat.
Yeah. See, you're assuming the relationship is purely transactional, like buying a tire for a car. But it's actually deeply symbiotic.
Explain that.
Well, if Jura wants to switch suppliers to save a few pennies on a circuit board, they can't just hand their current Uchi blueprints to a random factory in Vietnam.
Because Uchi is an ODM, so they own the blueprints.
Exactly. Uchi owns the proprietary hardware logic and the software source code.
Wait, so Jura is effectively locked out of the underlying architecture of their own coffee machines?
Precisely. They don't own the brain of the machine.
Oh, wow. That is a massive lock-in.
So to leave Uchi, Jura would have to initiate this completely scorched earth redesign of their entire flagship product line.
They just start from scratch.
The new supplier would have to write brand new code from day one. They'd have to design new custom microchips.
And attempt to perfectly reverse engineer all that complex thermodynamic timing that Uchi has spent decades refining.
Exactly. And even if they did that, they'd have to run this new, completely untested architecture through years of quality assurance testing.
Because for a luxury brand like Jura, the entire value proposition is flawless reliability.
Right, to the premium user experience. So introducing that level of execution risk just to save some marginal manufacturing costs, it would be corporate suicide.
They are completely tethered together. Uchi is the central nervous system, and you don't just swap out a nervous system to save a few bucks on hospital bills.
That's a great way to put it. The switching costs are just astronomically high.
High enough to form an incredibly deep economic moat.
And what's fascinating here is that this specific dynamic has allowed the Kao brothers to operate with a remarkably conservative financial culture.
How does the moat affect their finances?
Because they're an ODM relying on intellectual property rather than massive, heavy industrial manufacturing output, their business is extremely asset light.
Oh, they don't need to build massive new factories every year.
Right. They don't need to constantly take on billions in debt to build new fabrication plants. So this allowed them to operate entirely debt-free.
Wait, zero debt.
Zero borrowings. Entirely debt-free.
That is wild for a manufacturing company.
It is. And it set the stage for what analysts describe as their golden era.
Right. From around 2010, stretching all the way to 2023. Uchi basically became an absolute darling for dividend investors during that time.
Oh, they were legendary for it.
They weren't just profitable, they were a complete cash-generating machine. I saw their official policy states a minimum 70% dividend payout ratio.
That's the minimum, yeah.
But historically, they've routinely paid out anywhere from 70% up to an astonishing 119% of their net profits.
They were effectively just returning almost all their free cash flow directly back to the shareholders.
It sounds like a textbook defensive high-yield holding.
It really was. Until recently.
Which brings us to the very jarring contradiction that sparked this whole deep dive.
Let's get into the drop.
Right. Because if Uchi has this impenetrable software moat and a symbiotic relationship with a luxury titan and zero debt and a history of showering investors with cash...
Why did the floor suddenly give out?
Exactly. I'm looking at the chart, and in September 2025, the stock was trading really comfortably at RM 3.45.
Yep.
But fast forward to April 2026, and it had plummeted to RM 2.59.
It's a devastating 25% slide.
For a company known for extreme stability, that looks like a total structural failure. What happened?
Well, the optics are definitely terrible. But to understand the reality, we really need to dissect the financials.
Okay, let's open the hood.
For the financial year 2025, Uchi reported a revenue decline of 17%.
Okay, that hurts.
And what we call their core profit after tax, or PAT, that dropped by 18.7%.
Walk me through PAT for a second, just to ensure we're looking at the right metric here.
Sure. So profit after tax is simply the net income remaining after all operating expenses, interest, and corporate taxes have been deducted.
So it's basically the purest measure of the actual cash the business generated for the year.
Exactly. It's the bottom line. And an 18.7% drop in PAT is severe.
I mean, yeah, that's almost a fifth of their profit wiped out.
Right, and so the market panicked. They assumed this drop meant the moat was finally failing, that maybe Jura was selling way fewer machines, or that Uchi had lost their edge.
But that wasn't the case.
No. In reality, the drop was caused by what we're calling a triple threat of macroeconomic and cyclical factors that just happened to hit them all at the exact same time.
Okay, I'm looking at this 25% stock drop and struggling to see how this isn't a completely broken company. Walk me through what I'm missing. What is the first piece of this triple threat?
The first factor is a pure macroeconomic headwind. It's the strengthening of the Malaysian ringgit.
The currency.
Yeah. In finance, we usually call this transaction exposure, but for you listening, it's honestly much easier to conceptualize it as an invisible currency tax.
Okay, so how does the local currency getting stronger actually hurt a local company? Because intuitively, a strong ringgit sounds like a really positive economic indicator.
Well, it's very positive for importers. But remember, Uchi is an exporter.
Right.
Think about the actual mechanics of their cash flow. Uchi's factories are in Penang. They pay their engineers' salaries in ringgit. They pay their utility bills in ringgit.
All their taxes are in ringgit.
Exactly. Their entire foundational cost base is anchored to the Malaysian currency. However, almost 100% of the revenue they receive from Jura
is paid in US dollars.
Exactly. It's paid in USD.
Okay, I see the mismatch there. They're earning in one currency and spending in another.
Right. So let's apply the actual exchange rates from the timeline of the stock drop to see how much this hurts.
Go ahead.
In September 2025, when the stock was at its peak, the exchange rate was approximately 4.22 ringgit to $1 US.
Okay, 4.22.
So hypothetically, if Uchi sold a single control module to Jura for $100 US, they converted that into 422 ringgit to put on their balance sheet.
Simple enough math.
But then the global currency markets completely shifted. The US dollar weakened significantly, and the ringgit strengthened.
Right.
So by April 2026, the exchange rate had compressed down to 3.96 ringgit to the dollar.
Oh, wow. So that exact same $100 US module, which takes the exact same amount of engineering labor and raw materials to make,
is suddenly only translating to 396 ringgit.
That's a huge drop, and Uchi didn't lose a single order.
Without losing a single order. Without Jura experiencing any drop in consumer demand, and without any failure in Uchi's technology whatsoever, the reported revenue in ringgit just took a roughly 6% haircut.
It literally acts as an unavoidable tax on their top line.
Exactly. So if you're an institutional analyst looking at a spreadsheet of ringgit-denominated earnings, you just see revenue shrinking, even if the actual volume of US dollar business remains completely flat.
But wait, surely a company with 40% operating margins could just hedge against that currency risk? Or, I don't know, demand Jura pay them more to make up the difference?
Well, hedging can definitely smooth out short-term volatility. but it cannot fix a sustained long-term currency trend.
You can't outrun the market forever.
Exactly. And Uchi cannot simply raise prices to offset the currency shift because Jura is selling their machines globally, usually pricing them in euros or Swiss francs.
So they're locked in?
Yeah, the entire supply chain is locked into these complex long-term pricing agreements. Uchi simply has to absorb that translation loss.
Okay, so the currency tax clearly explains a portion of the revenue drop. But an 18.7% drop in profit implies something a bit more fundamental than just exchange rates.
It does.
There had to be an actual volume drop in the physical machines being built, right? Which leads us to the second threat.
Right. The second factor is an inventory lag. It's what I call the wait-and-see period.
The wait-and-see period.
Yeah. And to understand this, we actually have to look past the spreadsheets and look at the physical retail environment.
Okay, take us there.
We have to look at the massive department stores in Berlin, the specialty appliance shops in London, and the luxury retailers in New York.
The very end of the supply chain.
Exactly. Now, Jura is a company driven by innovation, right? They release new generations of machines every few years.
Sure.
Throughout late 2024 and 2025, Jura is preparing to transition their product lines to a highly anticipated brand new generation of hardware.
Okay.
Now, put yourself in the shoes of a retail store manager. You've got a back room full of last year's Jura models.
Yep.
And you suddenly receive a memo from corporate that a shiny, heavily marketed new generation of machines is launching in exactly 3 months. What do you do with your procurement orders today?
Oh, I freeze them immediately. I am absolutely not going to order another pallet of old tech, knowing my customers are going to demand the new version in a matter of weeks.
Exactly.
I'm going to let my current inventory run down to basically zero to clear the shelves.
Right. It's kind of like when one car taps its brakes on the highway.
Oh, the phantom traffic jam?
Yes. Jura tapped the brakes to switch car models, and by the time that ripple effect reached Uchi all the way at the back of the traffic jam, orders had come to a dead stop.
Even though no one was actually in an accident.
That is the perfect analogy. In supply chain management, we call this the bullwhip effect, and it creates a temporary artificial vacuum in the manufacturer's order book.
Because the retailers purposefully paused their replenishments to clear the channel.
Exactly. For Uchi, this translated into dramatically softer production demand in late 2025.
And consumers hadn't actually stopped buying luxury coffee.
Not at all. The wholesale pipeline was simply holding its breath, waiting for the new models to physically arrive.
Wow. Okay, so the combination of those two factors, the currency tax eating the margins, and the inventory traffic jam stalling the actual volume that explains the massive drop in profit after tax.
It explains the fundamentals, yes.
But it doesn't really fully explain why the stock price itself collapsed so violently. Which brings us to the third and final piece of this puzzle.
The emotional shock to the market.
Emotional shock. What was the third threat?
The third threat was the dividend cut. And this is really where the mechanics of corporate policy violently collide with the psychology of the retail investor.
Well, wait, we established earlier that Uchi was a dividend darling. They were returning massive yields. And they have that strict, unyielding policy to pay out a minimum of 70% of their net profit?
Yes, they do.
So if they are still honoring that 70% policy, why did the funds panic and sell?
It comes down to absolute versus relative returns.
Okay, explain that.
Yes, Uchi absolutely maintained their percentage policy. But just think about the underlying math for a second.
Right.
If your underlying net profit drops by 18.7% due to the currency and the inventory lag,
Right.
your dividend payout is going to drop in absolute terms, even if you are still faithfully paying out 70% of that smaller profit pool.
Oh, I get it. The slice of the pie is the exact same percentage, but the pie itself just shrank dramatically.
That is exactly the reality that faced the shareholders.
So what were the actual numbers on that?
In financial year 2024, Uchi paid out a total dividend of 29.5 cents per share.
Okay, 29.5 cents.
But in financial year 2025, that payout dropped to 19.5 cents per share.
Wow, that's a full 10-cent drop. That's huge.
It's massive. Now, consider the institutional landscape here. There are massive billion-dollar income funds whose entire corporate mandate is just to secure highly stable yields for their clients.
Like pension funds and retirement accounts.
Exactly. And their computer models are quite literally programmed to flag any stock that cuts its dividend by, say, 30%.
It just triggers an alert.
More than an alert. When that 19.5 cent figure was announced, it triggered automated sell-offs.
The algorithms just dumped it.
Income-seeking funds just bolted for the exits. They aren't interested in the nuances of inventory lags or currency translation or long-term moats.
Right, their mandate just says sell, so they sell.
And that exerts brutal, sustained downward pressure on the stock price.
But here's where it gets really interesting to me. Looking at this triple threat in totality, the whole narrative shifts completely.
It really does.
None of these three threats actually mean Uchi's underlying technology is failing. Jura isn't leaving them. The ODM software moat hasn't been breached at all.
Not even a little bit.
The 25% drop is almost entirely the result of cyclical retail plumbing and macroeconomic crosswinds.
The engine of the business is pristine. It is simply driving through a very heavy storm.
So to determine when that storm is actually going to pass, we have to look at what those retailers were actually making room for.
Exactly. We have to examine the new product pipeline that's expected to pull Uchi out of this cyclical trough.
Let's explore these new launches then, because this is where Uchi's software prowess really comes into play. The research highlights two specific new machines that represent the future revenue stream.
Right.
Let's start with the Jura C3. What is the strategic play with this particular model?
So the Jura C3 represents a major strategic pivot into what we can call compact luxury.
Compact luxury, because historically, Jura is known for these large, imposing, hyper-premium machines. Right?
Exactly. They are literal status symbols. They command a massive footprint on a kitchen counter, and they come with an equally massive retail price tag.
They're gorgeous, but huge.
Right. But the C3 is designed to capture a completely different demographic.
They're targeting the urban consumer.
Precisely. I mean, not everyone has a sprawling suburban kitchen island.
Yeah, if you live in an apartment in London or a condo in Tokyo, you might have the disposable income for luxury coffee, but you literally do not have the physical space for a flagship Jura machine.
Exactly. So the C3 condenses that entire premium Jura experience, the precision burr grinder, the exact thermal extraction, the sleek interface into a significantly smaller, much more accessible chassis.
And crucially, a slightly more accessible price point.
Which is the key.
This makes the C3 a huge volume play. If Uchi is writing the software and building the modules for a machine that's designed to sell in vastly higher quantities to younger professionals, that expands their total addressable market significantly.
It really broadens the base. It gets people into the ecosystem earlier. But, Jura is still fiercely protective of its premium status.
Naturally.
Which brings us to the second, and arguably much more important, product launch. The 5th generation E8.
The E8, this is the heavyweight, right? The data shows this is historically their bestseller globally.
Oh, without a doubt. The E8 is the machine that defends Jura's territory at the absolute top of the premium market.
Okay, so what makes the 5th generation so special?
The 5th generation really requires us to look closely at how Uchi's software dictates the user experience. Because in modern luxury appliances, the physical hardware is kind of becoming commoditized.
Like a water pump is just a water pump.
Exactly. A heating coil is a heating coil. What actually makes a $2,000 coffee machine feel luxurious today is the user interface.
Walk me through the mechanics of that. What does Uchi's code actually do inside the E8?
It basically manages this invisible symphony of micro-adjustments.
A symphony. Give me an example.
Okay, so when a user selects, say, a flat white on that beautiful high-resolution touchscreen,
Right.
Uchi's code has to instantly tell the thermoblock to heat the water to precisely 92 degrees Celsius for the espresso extraction.
Very specific.
Simultaneously, it has to command a completely separate heating circuit to prepare steam for the milk.
Okay, 2 temps at once.
Then it controls a variable speed pump to pre-infuse the coffee grounds with low pressure before smoothly ramping up to high pressure.
All while the user is just standing there waiting.
And it calibrates an electronic ceramic valve to inject the exact right amount of air into the milk to create microfoam rather than just large soapy bubbles.
And it has to do all of this in a matter of seconds, flawlessly, every single time.
While providing a totally bug-free smartphone-level touch experience on the display screen.
Because if the screen lags even a little bit or the milk is too hot, the whole illusion of luxury is shattered.
Exactly. Uchi's software programming is quite literally what justifies the exorbitant retail price of the machine. It transforms a mechanical tool into an elite experience.
And maintaining that engineering capability requires constant investment. The research shows Uchi consistently reinvests roughly 3 to 4% of their total revenue strictly back into R&D.
It is a relentless development cycle for them. They currently have roughly 18 active projects in their R&D pipeline.
18. For a relatively small ODM team in Penang, 18 simultaneous projects is staggering. What does concept evaluation actually entail for them?
It means they aren't just sitting around taking orders. They are actively prototyping the future of the industry.
Like what?
Concept evaluation involves building custom circuitry, writing beta firmware, physically testing sensor durability under extreme heat and moisture.
You're making sure it doesn't fry when it gets wet.
Right, and ensuring the new hardware logic can communicate with Jura's evolving design language. And out of those 18 projects, the reporting indicates that about a third of them are expected to clear the final hurdles and hit mass production by late 2025 or early 2026.
That's a lot of new product hitting the market soon.
Furthermore, they maintain a staggering 100% on-time project launch rate.
Right, 100%.
Yes. When a client needs a module by Q3, Uchi delivers it by Q3, without fail.
Okay, I hear that, but I have to interject here. Because I'm looking at management's own financial guidance, and it feels completely contradictory to this whole narrative of innovation.
I know exactly what you're going to ask.
If they have an active R&D pipeline, a flawless launch record, and they're rolling out these incredible volume and flagship models like the C3 and the E8...
Why the flat guidance?
Yes. Why on earth did Uchi's management guide for flat USD-denominated sales for the upcoming financial year? If the new machines are the saviors, shouldn't sales be rocketing upward? Are they expecting the products to fail?
Okay, that tension right there between the exciting product launches and the totally flat guidance, that is the most crucial dynamic for investors to grasp right now.
Help me grasp it.
Management is absolutely not predicting failure. What they are doing is acknowledging macroeconomic reality.
The global economy.
First, there's an inherent delay in the ODM supply chain. Even though Uchi is successfully shipping the new modules right now, massive volume reorders won't materialize instantly.
Right, because the retail channels need time to physically stock the shelves.
They need time to execute global marketing campaigns and basically persuade consumers to actually make high-ticket discretionary purchases.
The plumbing just takes time to pressurize.
That's a good way to look at it. But more importantly, management is looking at the global consumer right now.
And the consumer is tired.
We are in an environment characterized by very sticky inflation and high interest rates across Europe and North America.
Which are Jura's primary markets.
Exactly.
Yeah.
And even affluent consumers exercise caution when the overall cost of living spikes. So Jura is likely feeding Uchi very, very conservative volume forecasts for the immediate future.
To avoid overstocking their own warehouses in a fragile economy.
Exactly. Uchi's management is simply reflecting that caution back to the market. They would much rather set a realistically low bar and clear it, rather than promise explosive growth in a tight monetary environment and miss expectations.
Okay, let me test my understanding here. We know the history, we see the cyclical threats, we understand the technology powering the new product cycle, and we recognize the cautious global environment. It is time to run the actual numbers. We need to perform a value check to figure out what this company is intrinsically worth today. Let's start with the foundation of their balance sheet, which is what analysts refer to as the cash fortress.
In an era of hyper-leveraged corporate finance, Uchi's balance sheet is a total anomaly.
Because they maintain zero debt.
Zero debt. Let me repeat that. Zero borrowings. And they are sitting on a net cash pile of approximately RM 133 million to RM 136 million.
Okay, for a company with a market capitalization of roughly RM 1.2 billion, holding over RM 130 million in pure cash is a staggering safety net.
It's massive.
I try to explain this in personal finance terms. Imagine you own your house completely outright. You have no car loan, no credit card debt.
Sounds nice.
And you have 5 years of your salary just sitting in a high-yield savings account. If you lose your job for 6 months, you don't panic. You just write it out.
Exactly. That cash pile provides immense strategic optionality. In an environment where interest rates are super high, heavily indebted companies are basically being crushed by interest payments.
But Uchi doesn't have that problem.
Not at all. They can use that cash to fund their R&D uninterrupted. And critically, they can use it to backstop their dividend payouts even during a temporary revenue dip.
Which prevents total capitulation by the institutional investors?
Exactly. It creates a floor.
But the cash is only part of the story. The true engine of their valuation model is their margin power. The numbers show their operating profit margins consistently hover above 40%.
And to really contextualize a 40% operating margin, You have to compare Uchi to the broader electronic manufacturing services, or EMS sector in Malaysia.
Okay, what does a normal EMS company look like?
If you look at a typical EMS firm, a massive factory assembling televisions, vacuum cleaners, basic consumer electronics, they survive on brutal, razor-thin margins of maybe 5 to 10%.
Wow, 5 to 10. So it's basically a race to the bottom on labor costs.
Precisely. They make their money purely on massive volume and relentless operational cost cutting.
But Uchi's doing 40%.
Because Uchi is operating as an ODM. They are not just selling cheap assembly labor. They are selling proprietary code. That software component allows them to extract software-like margins from a physical hardware product.
Okay, so we have a fortress balance sheet, zero debt, massive cash, and software-level margins. How do the professional analysts actually turn those factors into a concrete stock price? We need to look at the discounted cash flow, or DCF, analysis.
Right.
Walk me through the mechanics of a DCF without getting too bogged down in the spreadsheet formulas.
I'll keep it simple.
Yeah.
The underlying logic of a DCF is straightforward. An analyst views a company as a machine that simply generates cash year after year.
Okay.
A DCF model attempts to forecast exactly how much cash Uchi will generate over the next 10 years.
Makes sense.
But because a ringgit earned 10 years from now is inherently worth less than a ringgit in your hand today.
Due to inflation and opportunity costs.
Exactly. The model has to discount those future cash flows back to their present value.
Because if you handed me a ringgit today, I could invest it at 5% interest. If you make me wait 10 years for that ringgit, I lose an entire decade of compound growth.
Exactly. And the mechanism used to penalize those future cash flows is called the discount rate, or the weighted average cost of capital, the WACC.
Okay, the WACC. And the research shows analysts are currently applying a WACC of 10.0% to Uchi.
They are?
10% feels exceptionally punitive for a company with no debt and a massive cash pile. Mathematically, dividing future cash by 1.10 compounded every single year aggressively shrinks the present value. Why are they penalizing Uchi so heavily?
The high discount rate is basically the mathematical expression of risk.
What risk? They have zero debt.
Specifically, it accounts for the single customer risk we discussed earlier. Even though the ODM moat is deep, the market absolutely hates uncertainty.
Right, the Jura dependency.
The fact that up to 90% of their revenue is tethered to one Swiss coffee brand means there's an inherent, undiversifiable risk that just has to be priced into the valuation.
If Jura falters, Uchi has no safety net of other clients to fall back on.
Exactly. The 10% WACC is the market demanding a much higher rate of return to compensate for taking on that massive concentration risk.
That makes logical sense. You demand a premium to ride in a car with only one driver.
That's a fair analogy.
What is the other critical assumption in the DCF?
The terminal growth rate. A DCF models the first 10 years explicitly, but then it has to assume a flat growth rate for the rest of the company's existence.
Out into infinity.
Right. And analysts have pegged Uchi's terminal growth rate at 2.5%.
Why 2.5% specifically?
Because it roughly aligns with Malaysia's long-term GDP growth target. The analysts are making a very conservative assumption that, over the infinite horizon, a mature company like Uchi will simply grow at the baseline pace of the broader economy.
Rather than experiencing crazy hypergrowth.
Exactly.
There is one more element of their valuation I want to unpack, which I rarely see in standard manufacturing analysis. It's the pioneer status. The reports mention a special government tax exemption.
Oh yes, the pioneer status. This is granted by MIT, the Ministry of International Trade and Industry in Malaysia.
Okay, what does it do?
It is basically an incentive designed to aggressively encourage advanced technological research within the country. Uchi secured this status specifically for designing a configurable presence and distance sensing time-of-flight module.
Okay, let's break down that jargon immediately. What is a time-of-flight or TOF module, and how does it relate to coffee or biotech?
A time-of-flight sensor works conceptually a lot like radar or LiDAR, but it uses light instead of sound or radio waves.
Okay, so it shoots a laser.
Basically, it emits a pulse of light and measures the exact nanosecond it takes for that light to bounce off an object and return to the sensor. This allows the device to create highly precise 3D spatial awareness.
Wow. How do you use that in a coffee machine?
Well, in a coffee machine, a TOF sensor could instantly detect exactly where a cup is placed on the tray. It could determine the exact size and height of the cup and automatically adjust the dispenser height to prevent splashing.
That is intensely premium.
And in a biotech setting, it could be used for incredibly precise robotic positioning in automated lab equipment.
It's cutting-edge spatial awareness tech.
It really is.
Yeah.
And the financial benefit is huge. The pioneer status grants Uchi a 100% tax exemption on statutory income derived directly from this specific product stream until 2027.
100%. It acts as a massive government subsidy for innovation.
It does. It allows Uchi to pour resources into bleeding-edge sensor technology, knowing that when it commercializes, the initial profits will be completely shielded from corporate taxes.
So if we step back and combine all this, a debt-free balance sheet, RM $130 million in cash, 30% margins, government tax shields, and a valuation model based on a really conservative 2.5% terminal growth rate.
That sounds perfect, right?
Yeah. Why isn't this stock trading at RM 5.00? If they are effectively immune to bankruptcy, why are the professionals treating it with such extreme caution?
To understand that hesitation, we really have to look at the latest Hong Leong Investment Bank, or HLI, report.
What did HLI say?
HLIB initiated coverage with a very firm hold rating and a target price of RM 2.90.
A hold rating. You know, a hold rating in the analyst world is essentially purgatory.
It really is.
It basically translates to, we don't hate the company quite enough to issue a sell order, but we certainly don't see enough upside to risk our reputation calling it a buy.
That's a very accurate translation.
Why are they so hesitant?
Well, HLIB outlines a very clear bearish case. First, they point to the softer demand and the unfavorable product mix during the Jura transition period, which we already discussed.
The wait and see period.
Right. They also heavily weigh management's cautious guidance of flat sales. If the CEO isn't forecasting growth, an investment bank is absolutely not going to invent growth for their models.
Fair point.
But the core anchor holding down the rating, the real issue, is the total lack of visibility on any new ODM customer wins.
This feels like the crux of the entire bear argument.
It is.
Uchi has definitively proven they can be the perfect silent partner for Jura. But they have yet to prove they can replicate that success with another massive Tier 1 global brand. They just haven't landed a second Jura.
And until they diversify that massive revenue stream, their growth trajectory is completely capped by Jura's ability to sell coffee machines.
They're wealthy passengers, but they are still trapped in Jura's car.
The market desperately wants to see them leverage their biotech expertise or their top sensor technology to land a new, massive anchor client.
And until that happens, the single customer risk just prevents multiple expansion.
Precisely.
But even HLA, while trapped in this hold purgatory, acknowledges a massive bullish counterweight that prevents them from issuing a sell rating.
It all comes back to the yield.
A dividend.
Right. At the depressed price of RM 2.59, Uchi offers a dividend yield of over 5%.
A 5% yield on an asset with zero debt and a cash fortress is highly attractive for income investors.
It is, and that yield is strictly backstopped by the 70% minimum payout policy and the RM 133 million cash pile.
So they can afford to keep paying it.
Even if earnings remain flat for a while due to currency headwinds, Uchi has the liquidity to maintain that attractive payout.
That yield basically acts as a valuation floor. It operates like a parachute, preventing the stock price from crashing any further, even if the lack of growth prevents it from soaring.
Exactly. It's a very comfortable parachute.
Which brings us to the final verdict. We spent this entire investigation exploring the Cow Brothers' journey, the ODM software moat, the complex mechanics of the currency tax, and the inventory lag.
The promise of the C3 and E8.
And the mathematics of their cash fortress. We need to weigh all this evidence. Is Uchi Technologies currently a sale-like, a deeply discounted gem unfairly punished by short-term cyclical plumbing?
Or is it a warning sign? A value trap destined to just trade sideways forever as a stagnant utility?
What's the case for buying?
The bull case rests purely on patience. If you buy Uchi today, you are betting that the ODM moat is truly impenetrable. You are acquiring a cash fortress yielding 5% while you wait for the macroeconomic storm to clear.
You believe the currency tax is cyclical, not structural.
Right. And you believe that the launch of the C3 and E8 will inevitably drive massive volume growth once the retail channels normalize.
It's a classic deep value setup. But the bear case is equally potent.
It really is.
If you avoid Uchi, you are terrified of the single customer risk. You are worried that sticky global inflation will permanently impair European luxury spending.
You fear the strong ringgit is the new normal.
And most importantly, you see a mature company that has failed to acquire new clients, slowly transitioning into a stagnant, albeit highly profitable entity. The risk isn't bankruptcy. The risk is dead money.
In the capital markets, narratives only change when a catalyst forces them to change. And for Uchi, there is a very specific date that every investor needs to circle on their calendar right now.
Late May. Specifically, the upcoming quarterly earnings report expected around May 27, 2026.
That May 27th report will be the definitive signal. It will provide the first clean, unvarnished look at how the new Jura C3 and 5th Gen E8 machines are actually performing in the global retail market.
We will finally see the math. Will the new machines translate into renewed, tangible revenue momentum?
Will the wait-and-see inventory vacuum finally be filled by massive reorders?
Or will the strong ringgit and cautious consumer demand continue to suppress the bottom line, validating all the fears of dead money?
The market is tired of theories. On May 27th, they demand proof.
As we conclude this investigation, I want to leave you with one final, slightly provocative thought. This wasn't really covered in the analyst reports, but it feels super critical when discussing an ODM in 2026.
What is it?
Well, we've established that Uchi's entire empire rests on the proprietary software code they write for Jura's hardware logic.
Their mastery of that code is their ultimate barrier to entry.
But look at the trajectory of technology right now. Software development is accelerating at an unprecedented, violent pace.
Oh, I see where you're going with this.
Artificial intelligence and large language models are making coding exponentially faster, cheaper, and vastly more accessible. Think ahead 3 or 5 years.
It's a wild thought.
What happens if AI makes it trivially easy to design and debug mixed signal control modules? What happens if Jura decides they no longer need to outsource their brains to Penang because a small in-house team armed with advanced AI coding assistants can just replicate Uchi's software in a matter of months instead of years?
That is the ultimate existential question for any software-driven ODM right now.
Does that impenetrable, decades-old moat suddenly evaporate overnight?
Does their historical mastery of code remain a protective fortress, or does the rapid advancement of artificial intelligence completely commoditize their greatest asset?
It is definitely something you have to factor into your thesis, especially the next time you hear the quiet hum of a perfectly engineered espresso extraction. Thank you for joining us on this exhaustive deep dive into Uchi Technologies' Berhad. We really hope we've stripped away the jargon, exposed the mechanics behind the business, and given you the analytical tools to see beyond the daily stock ticker. Keep questioning the consensus, stay curious, and we will see you on the next deep dive.